Welcome back to the deep dive. Our mission today is pretty laser focused. We are synthesizing the 2026 investment outlook for you.
We are.
And we have to, because the market landscape is shifting in ways we really haven't seen in decades. If you feel like the last few years have presented a picture that was, I think some of our sources from JP Morgan called it cloudy and blurred,
That's a good way to put it.
well, rest assured, the new frontiers, they're becoming much more clearly defined.
That's exactly right. We're moving beyond that ambiguity, that sort of guesswork that really characterized the immediate post-pandemic era.
Right.
To be truly well-informed right now, you have to understand the powerful collision of forces that are shaping global capital. We see three massive interconnected themes defining this new investment playbook. It's really a structurally different market regime.
Okay, let's unpack these three defining forces that you've synthesized from our source material. What are they?
Okay, first up, we have the revolution, which is artificial intelligence.
Oh.
AI. It's the promise of generational productivity gains, but it's also carrying the very real risk of overenthusiasm and, profound labor disruption.
And the second?
Second, there's global fragmentation, the dividing world order, where security and resilience are simply replacing globalization and cost efficiency.
And the third piece of this puzzle?
And finally, we are navigating inflation. A structural shift toward higher and more volatile price levels that really challenges decades of traditional portfolio construction wisdom.
Wow. That is a complex combination of forces. You got technology, geopolitics, monetary policy, all wrapped up together. So let's start with the economic baseline for 2026 before we really dive into the details. The overall expectation is, maybe surprisingly, one of U.S. economic resilience.
It is, yeah.
Which supports risk assets like stocks and corporate credit, and it's leading to what's expected to be another solid year of returns for multi-asset portfolios. But the path there isn't. It's not smooth, is it?
Yeah.
Especially early on.
No, it definitely isn't a straight line. The sources are anticipating a pretty peculiar cyclical movement. Early 2026 will likely see both economic growth and inflation heat up.
Eat up.
Yeah, due to a specific set of drivers that analysts have termed OBBA impacts.
Now, wait a minute. We need to pause right there. If you are listening to this, you might not be familiar with OBBA.
Fair enough.
That sounds like jargon designed to confuse. What exactly are the OBBA impacts?
That is fair. It's a bit of an acronym soup. But the sources use it to distill 5 structural factors that are driving the economy. It's onshoring, block formation, the burdening of debt, baby boomers retiring, and automation, so AI.
Okay.
These factors, when you put them all together, they suggest that inflation and growth will be higher and stickier than they were in the previous decade.
And that explains the hot start to the year.
Exactly. The early 2026 strength comes from the immediate positive impacts of automation starting to boost productivity, combined with all that government spending that's associated with onshoring and infrastructure buildouts. That provides a real cyclical boost right out of the gate.
So those structural factors give us a hot start. But that momentum doesn't last, according to the forecast.
Correct. When we look further out into 2026, the cumulative effect of higher tariff levels, which we'll get into the details on that later,
Right.
combined with lower immigration rates, that's expected to kick in. And that causes growth to slow and inflation to cool down in the later part of the cycle.
So cyclically speaking, we're looking at a tale of two halves for the U.S. economy, driven not by the Fed, but by these deep structural shifts.
That's the key.
And what about the U.S. dollar? I mean, it's been such a consistent story of strength for the last decade. This new structural environment seems to be signaling a decisive shift away from dollar dominance.
A decisive shift indeed. And it's a key element that helps bridge us from the economic context into the geopolitical one. The U.S. dollar is expected to weaken further, confirming the end of that really long bull cycle.
And we've already seen signs of this.
Oh, yeah. We already saw a significant decline in 2025, down 7% year-to-date by late in the year. This projected continued weakening is driven by two things. First, the closing of the growth gap between the U.S. and the rest of the world.
No.
And second, critically, the geopolitical pushback against what some sources term the weaponization of the dollar.
You mean the sanctions, freezing reserves?
Precisely. The use of sanctions and reserve freezing, which just incentivizes other nations and central banks to diversify away from the dollar.
And that weakening dollar projection, it feeds directly into the monetary policy discussion. There seems to be a huge disconnect between what the market is pricing in and what analysts expect the Federal Reserve to actually do.
It is a massive disconnect. The market is currently pricing in a far more aggressive easing path, something like 80 basis points of cuts.
Which would only make sense if we were heading for a recession.
Exactly. That's what you'd do if the economy were heading toward a sharp recession. However, given those stickier structural inflation drivers we just talked about, the OBBB impacts, analysts expect the Fed to follow a much shallower easing path, reducing rates likely only 2, maybe 3 times throughout all of 2026.
So that's the central tension for fixed income investors right now. The market is betting on significant cuts while the Fed is expected to be much more restrained.
Yep.
But history also shows the Fed often overshoots. If they're this patient, aren't they running a huge risk of letting inflation get unanchored, forcing some kind of emergency tightening later?
That is the great risk, and the Fed knows this. That's precisely why they're anticipated to be so much more patient than the market assumes. They want to avoid repeating the policy error of the 1970s at all costs.
So they're just staying in this rate normalization mode, but at a glacial pace.
A glacial pace is the perfect way to put it. The structural preference for caution, it suggests long-term rates should remain range-bound, maybe with a modest curve steepening. For you, the investor, this means...
So not just chasing rate cuts.
Not at all. It's about income, especially from solid corporate, consumer, and municipal balance sheets. That will be key, rather than simply making these large directional bets on rate cuts.
Okay, that patience from the Fed is designed to combat inflation, but maybe the single biggest technological force that could be simultaneously inflationary and deflationary, and certainly a force the Fed can't control, is the AI revolution. So let's pivot to that. That's our first major theme. U.S. equities have had a heady run, especially the major tech names. The central question for investors in 2026 is inescapable. Are we looking at an AI bubble about to burst, a la 1999-2000?
The consensus, looking across a broad stack of data, is it's nuanced. It's definitely leaning away from an imminent collapse. The sources suggest that while there is absolutely clear froth building, especially in venture capital and some highly specialized subsectors, a major broad dot-com style bubble burst is not imminent.
And the key difference is the fundamentals.
The key difference lies in the fundamentals and profitability. And that's the depth we really need to dive into here.
Okay, let's do that. Let's dive into that comparison dot-com era versus today's AI boom, because the numbers are startlingly different. They really reflect a generational maturity in the underlying technology.
They do. Consider the valuation extremes. Back in March 2000, at the absolute height of the dot-com frenzy, the forward price to earnings, the PE ratio on the NASDAQ 100, it reached an astonishing 60 times.
60. So you're paying $60 for every $1 of expected future earnings.
Precisely. It was pure speculation on the future.
And compare that to the valuation of today's AI-driven tech index.
By late 2023, the NASDAQ 100 PE ratio stood at roughly 26 times.
Okay, still high, historically speaking.
Oh, it's high for sure.
Yeah.
But it's dramatically less than half the dot-com peak. Even the major AI players like NVIDIA, which briefly surpassed a $5 trillion market cap in October 2025, just immense nominal value. Even they have valuation multiples that are dramatically lower than the historical bubble peaks. The valuation may be heady, but it doesn't represent that same level of pure speculative mania we saw in '99.
And it seems like the biggest structural difference really comes down to one word: profitability.
Yes.
So many of those dot-com companies were just concepts, right? Often with no revenue, fueled purely by optimism.
Exactly. At the dot-com peak, only about 14% of the companies in the index were actually profitable. Today's leading AI firms, NVIDIA, Apple, Microsoft, Google, they are established, mature, profit-generating machines with massive cash flows and deep moats.
And we have hard numbers on this.
We do. We have hard numbers supporting this financial strength. NVIDIA, for example, reported a massive 53% net margin in 2024.
53%.
That is an enormous fundamental underpinning of earnings that just did not exist for the bulk of the companies driving that 1999 frenzy.
Okay, that being said, we absolutely need to add a caveat here. Because not every player in the AI ecosystem is generating 53% margins. Where is the froth actually building?
And that's the nuance that absolutely echoes the dot-com risk profile. It's among the nascent players. Many younger AI startups, particularly those focused on specialized generative AI models, still produce little to no revenue.
So they're just burning through cash.
Burning through cash based on potential alone. So while the incumbents are rock solid financially, the nascent disruptive layer of the industry is still highly speculative. That's what's fueling investor concern. You see surveys, for instance, showing that in late 2025, 54% of global fund managers said AI-related stocks were already in bubble territory. That tells you there's widespread caution, even among the bulls.
Right. And shifting to investment flows and concentration, the capital allocation today looks undeniably skewed. That's a classic indicator of market heat, if not a full-blown bubble.
The capital flood into AI is just unprecedented. It shows this immense investor belief. In early 2025, a stunning 58% of all global VC funding went to AI startups.
58%.
Yeah. That intense focus is crowding out nearly every other sector: fintech, biotech, general enterprise software. It absolutely has a bubble-like feel to it, and it contrasts sharply with the slightly more sector-blind mania of the late 90s.
And you see it in these new, almost surreal metrics.
Oh yeah, like valuation per employee. Some sources report that specialized AI heads are being valued at anywhere from $400 million to $1.2 billion in some acquisitions.
$1 billion for one person's expertise.
It signals immense heat in both the capital and the talent markets.
And the concentration risk is massive. Back in 1999, you had Cisco, Intel, Microsoft dominating the NASDAQ. How does today's market dominance compare?
Today, the concentration is similarly intense, though perhaps focused on even fewer names. The top A-tech names, NVIDIA, Microsoft, and Apple, they command a record share, something like 40% of the entire S&P tech market cap.
40%.
This creates a significant systemic risk. If that core group falters, or if, say, regulatory pressure emerges, the entire market faces considerable concentration risk. That's a major worry for general equity investors, who are effectively betting 40% of their tech exposure on the continued success of just 3 companies.
Okay, here's where it gets really interesting for me. The sheer, staggering scale of investment required to even compete. This AI race is being funded by big tech giants with balance sheets deep enough to create entirely new, multi-billion-dollar ecosystems. Let's talk about the massive capital expenditure, the CapEx, that's required to build these competitive moats.
The spending levels are truly historic. I mean, combined big tech AI spending is projected to hit $320 billion in 2025 alone.
Wow.
Which is a massive 30% increase from the prior year. They are racing to acquire chips, build these hyperscale data centers, and secure the necessary electrical supplies for their, voracious training projects and accelerating inference demands. This isn't spending on marketing or R&D in the traditional sense. This is infrastructure CapEx. It's designed to build a moat.
So if we try to put that $320 billion into some kind of historical context, is this investment level historically high compared to, say, prior technological transformations like the railroad or electricity?
We can. So AI investment is currently around 1% of U.S. GDP. If you look back at prior general-purpose technology cycles like electricity in the early 20th century, or the railroad build-out investment typically peaked at between 2% and 5% of GDP.
So we're not even at the peak yet.
This historical precedent suggests that as impressive as this boom has been, the sheer investment magnitude could potentially still double or even triple from here, provided, and this is a big if, the physical constraints don't limit it. We are likely only in the middle phase of this infrastructure build-out.
Okay, now we have to talk about monetization, because this is where the financial tension really plays out. Not all big tech spending is created equal, and the divergence between Microsoft and Meta is a perfect illustration.
This is such a critical distinction for investors because it separates those who are selling the shovels from those who are only using them. Microsoft is leading the current monetization efforts. They are seeing immediate revenue growth from Azure AI and Copilot adoption. They're reporting 175% year-over-year growth in AI revenue, totaling about $13 billion annually. They are effectively selling AI capabilities as a service. It's a platform player model that shows immediate, measurable returns on their CapEx.
And then you have Meta. Their spending is massive, tens of billions, but the direct revenue story is completely different.
Meta is the classic integrator archetype. They plan to spend something like $60 to $65 billion in 2025, and their whole aim is to embed AI into their core business advertising, search, content recommendation, rather than selling it as a standalone service.
So there's no line item for AI revenue on their income statement.
Exactly. The key here is that Meta has no direct AI revenue reported. Their spending is foundational. They're betting that AI will enhance their existing offerings and audience engagement enough to drive advertising sales. This strategy is immensely risky and capital intensive. It's a luxury that many smaller companies simply cannot afford.
And that brings up the vital financial tension between CapEx capital expenditures and OpEx operational expenditures. The source material draws a really sharp line between the two, which is vital for understanding long-term profitability at scale.
Absolutely. The tension is in scale versus sustainment. Capital expenditure, that's the upfront cost for chips, networking, the physical data centers, is about 60% to 70% of total AI costs. This spending creates the competitive moats. It's your entry ticket to the game.
But then you have to run it.
But then you have to run it. And operational spending, OpEx, which covers power, cooling, maintenance, that's the remaining 30% to 40% of costs. And this is what truly determines long-term profitability. OpEx is the sustained cost that can quietly kill a business model if your usage is inefficient.
And the distinction between training the models and using the models is key to managing that operational cost.
Precisely. The vast majority of computing power, we're talking 80% to 90%, is used for inference. That's the usage, the moment-to-moment running of the AI model.
Not the one-time training.
Not the training. Training, while extremely expensive, is a finite one-off or periodic startup cost. So profitability depends entirely on inference efficiency. This is why companies like Meta build their own infrastructure. For context, training their Llama 3.1 model alone cost over $483 million in cloud costs.
Wow.
At that scale, that kind of recurring cost quickly justifies the massive capex required to own the hardware and avoid the sustained cloud OpEx of renting computing time. They trade huge upfront capital costs for lower fixed operational utility costs.
Okay, let's talk about the genuine structural impact of this technology wave versus the speculative hype cycle. We established there's froth, but AI is also deeply integrated, which makes it fundamentally different from the theoretical promise of the 2000 environment.
That's the crucial differentiator. That's what stops us from being a pure bubble. By 2024, sources were reporting that between 70% and 78% of firms globally were already using some form of AI.
So it's not theoretical anymore.
It's not theoretical at all. It's deployed. It's embedded into supply chains, customer service, development pipelines. This deep integration suggests AI is a genuine generational shift, a foundational technology, even if the speculative investment moment is currently overdone. And the immediate impact is already visible. Early AI adoption has increased labor productivity by about 30% for firms that adopt the technology effectively.
30% is a transformative productivity gain, which leads us directly to the labor market impact. The potential for disruption seems immense, particularly for knowledge workers.
It is, and the estimates are just staggering. The sources estimate that over 60% of jobs in developed markets are vulnerable to upheaval, meaning AI can either augment or displace those roles.
And in the U.S.?
That represents roughly 71 million U.S. knowledge workers alone, creating what's effectively a $6 trillion addressable market for AI disruption. The pain will likely be acute in areas like basic customer service, routine coding, and high-volume legal discovery.
That sounds pretty dire. Does history support the idea that this technology will cause lasting mass unemployment? Or does it follow the traditional, maybe more optimistic pattern of technological waves?
History argues for the latter, though that is, cold comfort for those facing displacement in the near term.
Of course.
Major technologies throughout history, like the steam engine, mechanization, computing itself, they rarely cause lasting mass unemployment. Instead, they radically slashed the cost of goods and services, which unlocks new demand and ultimately creates entirely new, often white-collar roles that didn't previously exist.
Right. Computing displays clerical tasks, but it enabled industries like modern finance and logistics.
Exactly. We expect AI will follow this pattern, enhancing more jobs than it automates, but the displacement and the need for reskilling will be immediate and intense.
Okay, now for the hidden monster in the room. The physical constraints that could limit the AI expansion, which surprisingly brings us back to utilities and industrial sectors. This is the bottleneck we really need to understand.
This is perhaps the most fascinating and tangible limitation, and it completely reframes the investment case for old economy sectors. AI is utterly constrained by the need for massive, reliable power.
And when you say masses,
We're talking about large data centers consuming 50 to 100 or more megawatts continuously. That's enough energy to power a small city. To bring that operational expense to life, a single NVIDIA H100 GPU cluster can cost over $1 million annually in power alone, regardless of its processing output.
$1 million a year just for power for one cluster.
Yeah.
That puts the energy crisis into an entirely new context. Suddenly, energy companies and grid operators aren't just utilities, they're essentially the binding constraint on the digital future.
Precisely. And water for cooling is rapidly emerging as an equal limiting factor. This massive demand for power and water is already creating fierce local opposition, leading to high-profile project cancellations.
Really?
Oh, yeah. We've seen Amazon facing pushback in Tucson, and Google having projects curtailed in Indianapolis because they simply couldn't secure the water and power rights. The growth impulse from AI is certainly real. OpenAI, for example, has announced plans for data centers requiring over 25 gigawatts of capacity, which is well over $1 trillion in total capex, but the physical infrastructure must catch up or the digital promise will stall.
So for the investor navigating this environment, how should they capture AI value, given these structural shifts, the valuation froth, and these hard physical limits?
Selectivity and focusing on structural themes are paramount. The great shift is that the beneficiaries are broadening significantly. We are moving from focusing only on the innovators, the chip makers and core tech, to the enablers, industrials, utilities, power infrastructure, real estate, and the adopters, financials, healthcare, large enterprises that see that 30% productivity gain. You need to follow the money, and it's increasingly flowing into the infrastructure required to run the models, not just build them.
And what about capturing value beyond the public mega caps? Does the private market hold the keys to the next phase?
It absolutely does, and this is a structural change from the 1990s. Investors should recognize that the biggest opportunities in the application and platform layers, the specialized AI tools and software, might remain locked in private markets through the end of the decade.
Because companies are staying private longer.
Much longer now. The median age for a tech IPO is now 14 years old. It was just 8 years in the 1990s. This means public market investors captured the initial infrastructure wave, the chips in the cloud, but the real long-term value creation in the highly scalable application layer is increasingly accruing to private equity and venture capital.
That also means increased scrutiny on public AI companies. We need to talk about the crucial warning sign from 2025 regarding the profitability test, right? The Oracle stock crash serves as a stark reminder.
It is the perfect, crucial case study. Oracle's experience in 2025 is a critical warning. The stock saw a massive spike to all-time highs driven by these aggressive cloud and AI expansion announcements, huge capex pledges, in other words.
Right.
However, a sober assessment of capital expenditure costs versus actual revenue realization.
Meaning, investors looked at the balance sheet and realized the costs were eating into future profits.
Exactly. And that led to a violent unwind.
And how violent was that correction?
The stock crashed 50% from its peak. This confirms that investors are now demanding to see real proof. They're demanding to see if these AI integrations are translating into measurable efficiency gains and actual revenue lift, not just massive capex announcements. If a company can't show a clear path from capex to profitability, the market is poised to punish it immediately. The AI theme is real, but the profitability test is now merciless.
That brings us seamlessly to our second defining force, global fragmentation. We transition from the dollar weakening due to geopolitical mistrust, and that mistrust is fundamentally changing trade and investment across the globe.
We are experiencing a profound regime change. The era that was defined by the peace dividend, optimized cost efficiency, seamless globalization. It's over.
Gone.
Gone. The sources emphasize that 3 key anchors, the post-Bretton Woods dollar system, low security risks, and hyperglobalization, have all fundamentally shifted. In their place, we have fragmentation, tariffs, tech controls, and block formation. Security and resilience have entirely replaced globalization and cost efficiency as the strategic imperatives for corporations and governments alike.
So let's start with the immediate trade reality. Tariffs. How widespread are they, and what's the expected economic fallout for 2026?
Tariffs are no longer a niche tool. They now affect nearly 70% of U.S. goods imports by value.
70%.
Yeah, and it's pushing the effective tariff rate toward 15% to 20%. While U.S. retailers have largely absorbed the costs so far, we expect that through early 2026, an increasing share will be passed on to consumers. This contributes to that structurally higher inflation we noted earlier. This fragmentation sets a higher floor for inflation because reliability and security carry a premium.
And that has a real cost.
It does. For example, a U.S.-made semiconductor, mandated by onshoring efforts, is expected to be 5% to 20% more expensive than the same part made in Taiwan. Efficiency has given way to resilience, and that comes with a price tag.
And this fragmentation is driving a rapid U.S.-China decoupling, fundamentally reshaping global supply chains.
The decoupling began in earnest around 2018 and has accelerated dramatically. The share of U.S. goods imports from China has collapsed from a peak of 22% in 2017 to just 12% today.
That's a huge drop.
It is. And it's not only a trade story, it's a financial one, too. China's share of U.S. Treasury holdings has also declined sharply from a 14% peak to just 6% today, reflecting that geopolitical mistrust. Concurrently, the effective tariff rate on imports from China rose by 20% in 2025 alone.
One of the immediate investment implications of this decoupling seems to be the solidification of a North American trading bloc.
That is precisely what the White House and corporate boardrooms appear to be carving out. It's a focused strategy of nearshoring into a politically aligned bloc. Effective tariff rates on Canadian and Mexican goods are dramatically lower than those applied to China. Goods compliant with the USMCA agreement are exempt from the highest tariff rates, and the U.S. is utilizing tariff threats as leverage to close transshipment loopholes, basically preventing other nations from just rerouting products through Mexico.
Can you give us a tangible example of how this is playing out right now?
Sure. Mexico, for instance, recently signaled it would place a 50% tariff on Chinese autos to comply with U.S. concerns about transshipment. This signals a deepening alliance.
And you can see it on the ground?
Oh, yeah. The physical evidence is equally compelling. The Port of Laredo on the Texas-Mexico border handled $340 billion in trade in 2024, and that trade corridor is only expected to grow as companies pull supply chains out of Asia and move them closer to home. Investors need to look closely at logistics, industrial real estate, and manufacturing firms operating in that corridor.
Okay, shifting our focus overseas, let's talk about China. Their response to fragmentation and U.S. tech controls is characterized by this intensified external influence paired with an aggressive push toward internal innovation.
Geopolitically, Beijing is doubling down on bloc formation. They're deepening ties with Russia and North Korea and actively seeking a global South trading bloc, exemplified by the expanded BRICS organization.
But at home, things are a bit different.
At home, this external influence campaign coincides with the domestic reality check. Foreign direct investment, FDI, into China turned negative for the first time in decades. A historic reversal indicating international capital is pulling back.
But the narrative in Chinese tech is complicated by genuine innovation, especially in the AI race. They aren't just sitting around waiting for U.S. chips.
No, they are definitely catching up and showing massive capability. Chinese researchers captured 40% of global AI citations in 2024. That is 4 times the output of the U.S. and EU combined.
4 times.
Innovative Chinese companies are capitalizing on efficient AI models and leadership in EV hardware. Critically, the China Tech Index actually outperformed the NASDAQ 100 by about 5 percentage points over the last year.
So their own chips are becoming good enough.
That's the signal. Policymakers banning NVIDIA's export-compliant chips suggests a domestic belief that their own chips are now good enough for LLM inference and training comparable to U.S. competitors, even if those domestic chips currently require more energy to run.
It sounds like a success story driven by experts in innovation, but the overall economic picture at home is still struggling to reflect that strength.
That's the great Chinese dilemma for investors. China's trade surplus has ballooned to all-time highs, yet corporate earnings have failed to rise along with those exports.
So they're just exporting their excess capacity.
It underscores their reliance on exporting excess manufacturing capacity to compensate for weak domestic growth. The domestic old economy continues to suffer from anemic demand, especially in housing and construction. However, and here is the pivotal long-term investment insight. China's digital economy is now generating higher revenues than its property and construction sectors combined.
So that's the structural pivot.
That's the structural pivot. It signals that the economy is finally rebalancing. The investment thesis has shifted entirely from concrete and steel to data and code.
Okay, moving to Europe. The end of the peace dividend is triggering a massive new spending cycle we haven't seen in decades, a necessity driven by fragmentation and conflict.
The drawdown in defense production from 1992 to 2022 was just dramatic. Tanks down 77%, fighter aircraft down 57%. That era of low security risk is fundamentally over.
Right.
The new security regime necessitates what sources are calling conflict capex, mirroring the AI infrastructure spending. NATO has set new, higher targets for defense spending, around 3.5% of member GDP, plus another 1.5% for related infrastructure. The U.S. is also requesting a massive $1 trillion defense budget in 2026.
And this spending shift is translating directly into an investment opportunity in European defense companies, which have been pretty dormant for a generation.
Absolutely. The earnings for a basket of European defense companies are now expected to grow close to 20% through the end of the decade. That's a massive acceleration compared to the 7% compound annual growth rate seen from 2019 to 2024.
And it's not just defense.
No. European industrial companies are benefiting from digitalization and the accelerating data center investments we discussed earlier, driving strong demand for electrical equipment and capital goods that enable the AI infrastructure build-out.
You also point out a massive and I think often overlooked opportunity in Europe's private markets that ties directly to consolidation.
This is a really compelling feature of the European investment landscape. It's a vast, fragmented ecosystem. A remarkable 97% of companies with over 100 million euros in revenue are private,
97%. Compared to what in the U.S.?
compared to only 87% in the US. This means there's a huge pool of successful mid to large sized companies that are not accessible via public markets. This vast private market opportunity offers a strong risk reward profile, particularly in fragmented industries ripe for consolidation, like small cap manufacturing, specialized logistics, and regional financial services. This strategy often generates returns on par with their U.S. private market counterparts, but at lower entry valuations.
Finally, in the fragmentation discussion, we have South America, which sits at a critical resource nexus.
Hmm.
But wait, if South America is trading with both China and the U.S. to maximize its resource sales, doesn't that make them vulnerable to secondary sanctions or geopolitical blackmail, or does it truly make them resilient?
That is the right question to ask, and the short answer is it makes them strategically resilient but politically volatile.
So they're indispensable.
They are indispensable right now. The region accounts for 40% of global copper production, and Chile and Argentina are top holders of lithium reserves. This is critical because the AI revolution and the energy transition are driving up the need for these minerals simultaneously. They have structural leverage, and the investment flows reflect this importance. Chinese investment has steadily gained ground on U.S.-sourced FDI, and the region is actively trading with both global blocs. They are, agnostic to the fragmentation, provided they can sell their commodities.
And the valuation story there is also attractive for global investors seeking that resource exposure.
It is arguably the most attractive region from a pure valuation standpoint. Latin American equities are currently trading at a 10x forward price to earnings multiple.
And what does that mean in historical terms?
To put that into context for you, this places them in the 30th percentile relative to their own history. This means they are historically cheap. 70% of the time over the past several decades, they have traded at a higher valuation. Contrast that with developed markets and emerging markets Asia, which are trading in their 90th percentiles. South America offers a critical resource hedge against geopolitical risk and a source of growth at a relatively lower valuation.
Okay, this shift toward resilience and away from globalization brings us to our third powerful force, inflation. The post-GFC era of persistent low inflation is clearly over, and we are entering a new structural regime defined by high volatility and stickiness.
This makes inflation, once again, a central variable for portfolio construction after decades of benign neglect.
And the risk is real.
The risk here is profound. Holding large cash positions or long-duration fixed income in this environment can quietly and irrevocably impair your real wealth.
So what are the primary structural drivers of this sticky inflation, going beyond the temporary supply chain issues that have mostly resolved?
The drivers really fall into three structural buckets: psychology, capacity gaps, and the cost of resilience. First, psychology. The post-pandemic experience created this embedded belief among businesses and consumers that inflation is possible and probable again.
Right.
This has led to rapid corporate behavior changes, primarily in pricing power. For instance, grocery chains in Norway are reportedly using technology to adjust prices up to 100 times per day.
100 times a day.
That level of price flexibility highlights how quickly businesses are reacting to perceived inflationary pressures. It just makes price hikes easier and faster to implement.
That's a fascinating, if alarming, insight into modern pricing. Now, what about the capacity gaps that make these price hikes possible?
The capacity constraints are critical enablers of persistent price hikes. We see shortages in critical areas. First, labor supply. The decline in net immigration restricts labor supply, giving workers more wage leverage in key sectors. Second, power and electricity. This links directly back to the AI boom. Data centers and electrification create immense strains, pushing up utility and production costs. Third, commodities and manufacturing inputs. Shortages exist in key materials necessary for infrastructure build-out, like U.S. cement production, which is down 15% from its 2005 peak. These gaps allow producers that control bottlenecks to maintain strong, persistent pricing power.
And linking back to fragmentation, the third driver, the cost of resilience, is fundamentally inflationary.
It sets an enduring floor for inflation. Supply chain resilience, onshoring, and nearshoring mandates mean paying a premium for reliability, quality, and speed. We established that a U.S.-made semiconductor is expected to cost between 5% and 20% more than the same part made overseas. Those higher trade barriers driven by security concerns are translating into higher sticker prices for critical goods across the board.
Given this new regime, how should investors approach fixed income? Is the 60/40 portfolio truly dead?
The 60/40 portfolio isn't dead, but it must be reframed. While fixed income is still an attractive asset class and offers a generally positive outlook, especially after years of ultra-low rates, the strategy has fundamentally changed.
How so?
It's less about making a big directional bet on falling interest rates and much more about active management and disciplined risk control. The focus must be on generating income from high-quality credit, securitized assets, and global bonds tied to solid corporate and municipal balance sheets. Duration risk remains high, so tactical allocation is key.
And fragmentation and geopolitical mistrust are simultaneously boosting alternative stores of value. Gold and digital assets seem to be beneficiaries of this new world order where the dollar's status is being questioned.
They absolutely are. Global fragmentation incentivizes diversification away from the dollar by central banks and institutional investors. After Russia's dollar reserves were frozen, central banks globally reacted immediately. They started buying record amounts of gold, searching for independent alternatives not subject to sanctioning.
And that provided powerful support for gold prices.
Powerful, ongoing support.
And the performance of gold in 2025 has been just stunning, reflecting that institutional fear.
It has gained over 50% so far in 2025, reaching an all-time inflation-adjusted high, peaking recently near $4,585 per ounce.
Wow.
And that tremendous rally is anticipated to continue into 2026 as the geopolitical instability persists. Simultaneously, cryptocurrencies are gaining favor, driven by that search for dollar alternatives, perceived dollar weaponization, and adoption among developing nations. The total market cap for digital assets now exceeds $4 trillion, up from $2 trillion at the start of 2024, signaling its growing acceptance as an alternative financial rail.
Let's focus on one of the most visible capacity gaps in the U.S. economy.
Housing.
This is a structural issue with massive investment implications that ties directly into the inflation story.
This is a generational capacity gap that cannot be solved quickly. The U.S. has underbuilt housing units by an estimated 3 million to 4 million since the Great Financial Crisis.
3 to 4 million units.
At the current pace of construction, it could take 10 years to close that supply shortage. And compounding the problem is the affordability crisis. Due to elevated home prices and higher interest rates, the monthly cost to buy a home is roughly 50% higher than the cost of renting.
50% higher.
Which creates the worst affordability dynamics since the 1980s.
That immediately suggests a compelling opportunity in rental housing as demand shifts away from unreachable ownership.
That's the clear investment implication. We have a massive demographic cohort entering their prime home buying years. Over 6 million people will enter the 35 to 49 age group through the end of the decade.
Right.
And given the cost gap between renting and buying, demand for rental housing, especially newer family-suitable homes near growing city centers, is expected to surge. Housing, particularly high-quality rental assets, presents a compelling opportunity as an inflation-resilient asset class.
And real assets generally, like infrastructure and specialized real estate, are strong inflation hedges because of how their cash flows are structured, right?
They are excellent hedges because they mitigate inflation risk through contractual inflation-resilient cash flows.
Like what?
Well, think about rent escalators in long-term commercial property contracts or tariff adjustments in infrastructure projects. Global infrastructure, which has historically delivered 8% to 12% annualized returns during different inflation regimes, is particularly compelling now. Demand for power, driven by electrification and data centers, coupled with strategic initiatives to improve infrastructure resilience, has pushed the power sector to account for nearly 60% of the relevant global infrastructure index today. That's up from 20% just a decade ago. It is the core enabling asset of the new economy.
Okay, that gives us our three powerful forces: the AI promise, the fragmentation pressure, and the inflation volatility. Now, let's synthesize this into the 2026 investment playbook. What are the core strategies that you, the investor, need to employ?
The overarching strategy is selectivity, a laser focus on structural, secular themes rather than cyclical ones.
The big long-term stories.
Exactly. We are looking at the broadening AI investment ecosystem, deregulation in financials, and massive infrastructure buildouts as the core secular stories. Investors must prioritize quality, meaning companies with consistent profitability, strong pricing power, and low financial leverage. The days of indiscriminate growth investing are over.
And we keep coming back to that profitability test we discussed earlier, prompted by the Oracle scenario. You need to ensure the excitement translates into cash.
Yes, earnings scrutiny will intensify dramatically. The Oracle stock crash serves as a stark reminder. The market is unforgiving when capex doesn't translate to revenue. Investors must demand that AI integrations translate into measurable efficiency gains and revenue lift. The Oracle scenario, where the stock soared on cloud promises and then collapsed 50% from its peak due to a realization of massive upfront capital costs versus slow revenue realization, is a crucial warning sign that mass spending alone is insufficient.
So if 2025 was defined by buying the chip innovators, what is the most actionable trade for 2026 based on the physical constraints we've identified?
The most actionable trade for 2026 may well be the structural transition of capital flows from silicon production to energy consumption.
From chips to power.
From chips to power. Since the AI revolution is physically constrained by power and cooling requirements, the investment focus must shift toward the companies that supply that base layer. This means aggressively focusing on utilities, power generation, and grid efficiency firms. They are the essential monopolistic enablers of the entire AI ecosystem, and their contracted cash flows offer an inflation hedge.
Finally, diversification, that foundational principle of investing. Has the new frontier killed diversification?
Diversification is not dead, but it has certainly been reframed. Traditional portfolio construction faces challenges due to inflation volatility, but alternatives, private equity, private credit, and real assets play a crucial role. They allow investors to lean into specific secular themes like AI infrastructure or European consolidation, and they add crucial diversification to portfolios that are currently concentrated in mega-cap public tech.
And what about looking abroad?
Furthermore, foreign markets are increasingly competitive. The earnings growth gap between the U.S. and the rest of the world has significantly narrowed, presenting international opportunities that hedge against U.S.-specific concentration risk.
This deep dive has covered an incredible amount of ground. We've charted a complex new frontier defined by technology, geopolitics, and monetary structural shifts. We've talked about the dazzling AI promise, the grinding pressure of fragmentation, and the unavoidable volatility of the new inflation regime.
And the key takeaway for you, the learner, is to blend resolve, sticking to quality secular themes, and demanding profitability with agility, especially when managing duration and allocating to alternatives. Structural change is creating clear strategic advantages for those who understand the new rules of the road.
And that leads us to our final provocative thought for you to chew on. We spent a significant amount of time detailing how the AI revolution is heavily reliant on massive amounts of power and cooling, creating a bottleneck that has already led to local opposition and project cancellations due to water scarcity and power demand. So if the physical limits of power and water infrastructure determine the ultimate pace of technological advancement, what existing old economy sectors, like electric utilities, grid operators, or even natural gas producers that provide critical baseload power, are secretly the true gatekeepers of the new frontier? And are they currently valued appropriately for that hidden monopolistic power they hold over the entire digital economy?